incentives for this default will depend on the bank's balance sheet, the local bank's balance sheet, as this will measure what is the effect of a default on the local financial markets. So how do we do this? We follow very much the literature and the structure of models that have been used to study the doom loop. So we have a very simple 3-period model of the doom loop with multiple equilibria, where the multiple equilibria will in essence be very similar to the previous literature. And then we show that the two proposed policies can backfire, meaning cutting the nexus between the bank and the sovereign by, for example, forbidding a bailout, or, for example, by lowering the exposure of local banks. And this can backfire basically by the effect it will have ex ante on the risk premium of that sovereigns will face, because you're basically destroying this commitment device. And then we actually find that if you were to allow for countercyclical exposure of banks, this can avoid a market turmoil to develop into a crisis. So basically, one way to get rid of the doom loop is that during the crisis, if you were to allow your domestic banks to expand their balance sheet with the sovereign debt that you have to issue, in the case for financing the bailout, this could actually kill the doom loop and have to avoid ex ante any bailout in the case of a fully beliefs-driven crisis. So let me get to these points. These are the two literatures where we're basically linking the doom loop literature that, as I told you, emphasized that this doom loop, this double nexus between sovereign and banks, can create multiple equilibria if the feedback is strong enough, or can create an amplification. So an initial shock to the financial sector can end up having a larger effect on the economy because it spills over to sovereign risk. And the second strand of the literature we're linking is the whole literature on how banks' exposure to sovereign debt serves as a commitment device for the government. So we're linking these two, and then seeing and evaluating again those policies and finding out some alternative policies that could work in this setup. So our model is going to consist on several players, but the key player is going to be the government, basically. In the home country, we're going to have a representative bank, a representative household is going to be the one holding the deposits, entrepreneurs that will be the ones investing and getting credit, and a benevolent government that's going to be, as I told you, the key player. And then the rest of the world will be simply foreign lenders, individuals that are risk neutral, that will demand the sovereign debt from the government. So our 3-period economy time is the following. At the initial period, the government issues bonds, that these bonds can be held by the local bank or international creditors. And the bank conforms their portfolio. That will will also have credit to entrepreneurs. At t equal to 1, the next period, then a sunspot, we have an extension with a fundamental shock, but I will focus in this presentation on the sunspot. A sunspot shock is revealed, so it's a shock that is not fundamental, that is might only affect expectations, and then asset markets open and the sovereign decides if to bail out the bank, if the bank runs into problem, basically, as a response to the sunspot. And in the last period, where all consumption takes place, is when the productivity shock is revealed, output is generated, and the government has to decide if to strategically default or repay the debt. All assets pay off and the household decides to consume. So let me go a bit step by step in this overall framework, what is happening in each period. So just to understand better which are the assets in this economy, we just said all the assets will have face value of 1 and they will mature in t equal to 2. So the price of the asset will give us all the information about the interest rate implicit in the asset. And the household decides how many deposits to place at the bank. So this is the only decision of the household. They have some initial endowment. They have to decide how much they keep in their safe storage technology that has no net returns equal to 0, or how much they deposit in the bank. Then the bank has an initial capital, you could think as the endowment of the bankers, that they can leverage with deposits by taking this deposit from households. And the alternative investments of the banks are to give loans to entrepreneurs. That is a fixed mass of entrepreneurs, individuals with some projects in mind that will pay off in period 2. And the price of these loans is PL, the inverse of the interest rate. And they also could buy sovereign bonds from the local economy. And the price of the sovereign bonds times 0, we're going to refer it as Q0. On the other hand, foreign investors could buy also sovereign bonds from the local economy, and this will be their holdings, where we distinguish the two by having these home holdings and the foreign holdings. And finally, the government is forced to issue debt because they have to finance some exogenous amount of revenue that is R. So they have to finance by issuing a total amount of debt that is the sum of the debt that is bought by the home banks and the foreign investors at the given price. So this is the total revenue that the government gets by issuing this amount of debt, and they have to use all of this revenue to be able to finance these expenses that they need to take down in period 0. So then the next period is when the sunspot reveals. This is the realization of the state S that could be N for normal or P for panic. So we allow for a possibility for panic. And there is no fundamental difference between these two. That's why it's a sunspot. The only thing that this could have an effect if it could allow to coordinate expectations. So after that, the bonds market will open and there could be repricing of debt, where the price of debt at the end will always have to satisfy that since the foreign lenders will be the marginal buyers, the price of debt will have to be equal to the probability of repayment. That in this case will be 1 minus the probability of default. And after the repricing of debt, because the probability of default might change, the banks might face a bank run. Depositors could early liquidate, they might early liquidate their deposits, that they have a face value of 1 if they wait till liquidation after the period 2, but if they early withdraw, they are able to get an early face value that is lower than 1, I call lambda 1. And if they decide to early liquidate, the banks might be forced to liquidate some of their assets. They could sell sovereign debt, but if they don't have enough, they might have to liquidate also their loans. So the cost of this disruption, that they have to liquidate some of the loans that of the firms that are financing or the entrepreneurs that are financing, is that there's going to be a disruption theta 1, that of all of these projects, a fraction theta 1 is going to be destroyed. Okay. So we lose the supervision of banks that know that we're the one giving these loans. If they have to liquidate them, this theta 1 fraction will be destroyed. And under this possibility of the bank can face a bank run, the government can react by bailing out the bank, trying to avoid that there will be a bank run, but basically transferring resources to the bank in the way of a safe asset. So the bailout decision is basically if the government doesn't bail out the bank and there is a bank run, then we have that all of those projects that we initially financed, some of them are destroyed, and then we have a lower level of projects that are going to be able to produce at the last period in the economy. But if there is a bailout, then the government can transfer this amount of resources to the bank to make it solvent such that depositors do not run. And once they do this, they have to issue debt to the international markets. And that is bought by international creditors. So how much debt they have to issue, it depends. How much resources they need to bail out the banks, divided by the price of sovereign debt in that eventuality. So it's clear here from that the lower the price at which they sell debt, the higher they will have to get indebted in international markets to be able to finance the bailout they need to transfer to banks to avoid this inefficient liquidation of loan, because it's full inefficient liquidation. Then in the last period, the fundamental shock is revealed. So this is fundamental now because this is going to be productivity. So this is going to be the gross returns of all the projects that survive up until the last period. So all those projects that were not destroyed, they will have this return that will be faced by the local economy. And then after this productivity is revealed, the government can decide if to repay or to default on all of its debt. So the government cannot discriminate across local and foreign creditors. If they default on everyone. And if they do default on everyone, this can trigger a bank run because the bank is loaded with sovereign debt. If there is a default, there is a fall in their assets, and then depositors might decide if to early liquidate at the face value lambda 2. Again, smaller than 1. This basically capturing an interest rate on deposits that will be up to maturity. So if loans are liquidated, the same as before, if I had to liquidate the loan before maturity, if I had to ask for the money back from the entrepreneur before the project is finished, there is also a cost of that some projects will die, will basically be destroyed, and this is given by theta 2. So the final projects that will land into production are the ones that survive after this process, and then production takes place. Production simply is that all the projects that survive will generate this gross productivity omega, and this will give you the output. And that the final productivity will depend indeed also with a direct cost of default. So the cost of default, as in standard models like in Arellano, you could have a direct cost of default that is given by this eta, by this, let's call it this bar theta. So if default is equal to 1, we have to discount some products that will go because of default costs. But if the government repays, this is always equal to 0. And then what we get as production is just the productivity times the surviving projects. And at the end, we only have consumption. The local economy consumes their production minus what they have to pay to international creditors. Okay. So the cost of default is that you will have here a 1, so there will be a disruption, and there will be a cost of defaulting, and also possibly a disruption in financial markets. The benefit, if you default, is that you won't pay back this amount of debt, so you will be able to consume everything that you produce. And the objective of the government at the end, when taking all decisions, if to bail out or not, if to default or not, is going to be to maximize consumption. Did I lose you?
Okay. No, we can still hear you.
Okay, so this was my screen that was making some problems. Thank you. So this is the core of the analysis here. Bank solvency, the cost of defaults, and the doom loop. First, notice that a bank run will only happen if the run makes the bank insolvent. Because the bank is not insolvent and I'm a depositor, I could hold out, keep my deposits there, wait for the final resolution of projects, and I will have a higher payoff. Because an early liquidation comes with a discount. So only if the bank becomes insolvent after the bank run, there will be a bank run. So this is the condition for insolvency. Notice this is the total amount of transfer that the bank will have to give to depositors if they early withdraw at period T. This is the total deposit, the face value at final liquidation, and this is how much they can claim if they liquidate their deposit before time. So this is the total transfer that the bank will have to pay depositors if they run, and this is the total value of the assets of the bank if the bank has to be liquidate some of these assets. So this is the value of the sovereign debt holdings they have, and this is the value of the loans they have provided. Take into account that some of those will be destroyed if they have to liquidate them. And these are the safe assets that they hold. These safe assets in principle will come only from the bailout of the government. So this is clearly, this condition of the insolvency can be turned around by the bailout of the government. But the key thing to highlight here is that notice that Q is here, the price of sovereign debt. So if this price of sovereign debt falls enough, could make that this condition is satisfied, and then there could be a bank run. If the sovereign debt loses enough value, banks can become insolvent, as a bank run will entail. On the other hand, a bailout, if the government wants to avoid this, meaning transferring enough resources to the bank such that this condition does not hold, the bailout will increase the cost of repayment of sovereign debt. So if the government indeed engages in a bailout, they have to issue more debt. And these additional issuance of debt itself is what can satisfy that indeed sovereign debt price will fall, because now the government has more incentives to default. So this is more like the standard doom loop. The key thing that we have new in our setup is that the cost of default depends on the impacts on banks' insolvency. In the more standard approach, the default decision is simply taken with respect to the total amount of debt, and is irrespective of the cost of that will have in the local economy. Here we have this channel that the loan destruction, if you default and your sovereign financial system is exposed, will generate lower output. So there is a cost of default depending if your banking system is exposed or not to sovereign debt. But also a cost of repayment, how costly is for you to repay back sovereign debt depends on who holds the bond. If it is the local financial market, because it will be local economy and will be partially reabsorbed by the economy, or if it is only foreign investors, that will basically be just a transfer to the outside of the local economy. So these two elements are the ones that are going to be key and different in our setup to drive the results. So we include two assumptions that are basically used to have some action in the model. One is that banks are exposed. So if sovereign debt, if sovereign debt is, the price of sovereign debt goes to 0, banks will be insolvent. This is basically guaranteed by the fact that depositors have enough endowment that is larger than the stock of investment projects in the economy. So that actually, once the bank leverage, they put some of this money in sovereign debt. And this ensures that the doom loop exists. And the second condition is that there is solvency, that the bank's capital is large enough such that it can also sustain an equilibrium where there is no, where there doesn't have to be panic. Okay, so the bank capital is large enough so they can sustain this level of leverage. So we have the possibility of the first one allows the possibility of a doom loop of panic, and the second one allows the possibility that there could also be a situation where there is no panic in the economy. So basically, and the equilibrium is the model is characterized by the equilibrium of the sequence of decision and prices, such that the key player, that is the government, is maximizing the utility of the local economy, that consumption level of the local economy. And then we have the first case is that a simple equilibrium with a no sunspot. We can find that there could be an equilibrium where the sunspot, or this variable S that is revealed in period 1, does nothing in the economy, prices do not change, and then the equilibrium in that setup is simply going to be that the total amount of debt held by foreigners is the amount of resources that the government has to absorb from the outside of the economy. What is the resources? Is how much expenses they have to be financed. If you want the public expenses, private investment minus the local endowment. So this is what the local economy wants to absorb from the rest of the world, and this is divided basically by what is going to be the price of that issuance of debt. So this gives you how much debt has to be issued, and this price of the issuance of debt is precisely this term here, that is the expected repayment probability. Where a key element in this analysis is that this omega is going to be the threshold for default. Recall that omega is the productivity that is revealed in period 2. The optimal strategy to default by the government is a threshold strategy. If the productivity is low enough, the government defaults because the cost is lower and the gain increases. But if the productivity is very high, the government repays. And therefore, there will be a threshold at which the government is indifferent between repaying and default. And this threshold here is going to be a function of how much debt is held by foreigners and how much production we have in the local economy, or how many projects we have in the local economy that are active. And this is just the pricing equation for the international creditors, that the price of debt will have to be equal to the expected repayment. But we can also have a sunspot equilibrium. That is basically a self-fulfilling equilibrium. That if there is a panic, that the investors somehow expect that there will be a higher default probability. If they expect a higher default probability, there will be a lower bond price. The lower bond price can make banks insolvent, pushing for a bank run. And then the government might have the incentives to intervene, bailing out the banks, but the bailout is costly. So since they have to bail out the government, increasing foreign debt, the increase in foreign debt makes the default more likely. So there is the feedback loop that basically you start with expectations that end up generating that indeed the default probability goes higher. So this is a self-fulfilling equilibria where this is basically driven by panic. So this is the proposition of that equilibrium, where basically what you see that the threshold of default by the government, that is this WP, the threshold in case of panic, in case of the sunspot is given by panic, is the previous normal threshold, but now we're adding something. And this what we're adding is that we're increasing the region in which the government will default by the size of the bailout, how much the government has to transfer to the banks to make them solvent, but divided by the price of that issuance of new debt that they have to use to finance this bailout. So the lower the price of debt, the larger will be the cost of the bailout, and then the higher will be the threshold for repayment. So the less likely will be repayment, and therefore we have this feedback loop between the optimal decision to repay. It depends on the prices of sovereign debt, and at the same time, the price of sovereign debt depends on the optimal repayment decision. Okay, so the first one again is just the pricing function of the international creditors, that they price the bond in terms of the expected repayment probability. The second one is coming from the optimal repayment decision of the government, which is the threshold at which I'm indifferent between paying or not paying back. And this is just the size of the bailout that you need to make banks solvent again, basically to get rid of the equity shortfall that is suffering in case of a panic attack. So these are the two equilibria. As I told you, the green line is just the pricing of debt from international creditors for different default thresholds. That is this term here. For different default thresholds, the international creditors price the bond with the higher the default threshold, the lower the price at which foreign creditors are willing to buy the asset. So this is the blue line. And the red line is that for given different levels of prices for the sovereign debt, how do the incentives of the government to repayment change? So the red one gives you is that for a given price of debt, let's say QP, the incentive for repayment, or the threshold at which the government is indifferent between repayment and default, is given by the red line. So the equilibrium is where these two coincide. So the panic equilibrium is this one, where the shaded region is when where the banks are insolvent. Low sovereign debt price in that region take the bank to insolvency, and at this point is the equilibrium where At that price, the government optimally defaults at this above this threshold, below this threshold, sorry. But at that price, at the same time, at the threshold, creditors pay the debt exactly in the same point. So we have the fixed point of the equilibrium where we have this panic. Creditors believe the government is going to default with higher probability. This drives banks to insolvency. The government steps in bailing out, and this increases itself the default probability. So I'm going to try to go fast in these two policy experiments that are the key new elements of this paper. So one is no exposure. That's the typical proposal that happened, and the many papers following after proposes that the problem, all of this problem here is coming from the exposure of local banks to sovereign debt. So let's limit that exposure. Let's say that, for example, banks in Spain cannot hold sovereign debt from Spain above a certain threshold, 10%, 4%. And this will solve the doom loop. So what we say in this case is that if you reduce that exposure, you can do it by increasing the equity ratio, basically increasing the capital of banks, or by portfolio relocation, making that the banks cannot invest all of their money in sovereign bonds, but they also have to invest some of it in foreign bonds. The cost of this is going to be that the doom loop, the benefit that the doom loop disappears, you indeed break out this panic equilibrium, but the cost is that normal times when you don't face the panic get worse because you completely destroy the commitment value of the government. So you end up having lower prices for sovereign debt, and possibly, and we have under mild conditions the paper, lower welfare. So you go back to period zero when the government has to issue debt to finance their expenditures, and this breaking of the link between the banks and the sovereign generates lower commitment, lower price of sovereign debt, and therefore the need for high issuance of debt and then a more costly repayment. So this is what can lead to lower welfare. And we also explore the possibility that this change could destroy the doom loop that is a source of multiplicity in period one, but could generate the more classical doom loop in sovereign debt markets. That is when you have to issue debt, you might have to face itself multiplicity and a possibility of panic. That is not related to the banking sector, but just related to the fact that people might think you are not going to pay, and therefore you have to issue a very large amount of debt. So we go back to a more classical notion of the self-fulfilling clearance of sovereign debt markets. So this could backfire, this policy. I will not talk because of time about the bailout policy, but a commitment not to bail out is not necessarily going to destroy the doom loop. So let me focus on debt repatriation. Suppose now, because this is a policy that many of the different alternatives were fighting against, we don't want to allow European banks to load up with sovereign debt during the recession. This could increase the doom loop. This could increase the risks. We don't want the Spanish banks to load up on sovereign debt because there could be commitment problems. There could be moral hazard in the way they manage their portfolio. But we're going to allow for this possibility here that banks are going to bail out by be given additional government bonds. So instead of giving them the safe asset, they get sovereign debt directly. So they get this piece of paper from the government. The result of this, the sunspot equilibrium completely disappears because now when you have to finance the bailout, you're not increasing your exposure to foreign debt. And the foreign debt is the key element for the default decision. So you are making a bailout, but you're not increasing foreign debt, so you're not increasing the incentives to default, and this makes that the panic equilibrium disappears. And normal times do not change. So this commitment to bail out banks with additional bonds is going to be out of the equilibrium path. It will never be seen, but it will completely break the possibility of a panic. And you could completely centralize this promise by basically just issuing debt normally in international markets. But if you allow your local banks to expand their balance sheet by buying this additional debt, then you again just basically break the sunspot equilibrium. So this policy, you can decentralize it, but just allowing banks to trade in the bond markets. Basically, it's a renationalization of debt, and this renationalization of debt, what it makes is that lowers the incentive of the government to default, and this counteracts the doom loop. So it breaks the doom loop in that sense. So hence our conclusion in that case is that limits banks' exposure could be particularly bad in times of market turmoil. Because in the periods of crisis, if you allow the banks to expand the balance sheet with local debt, what they are going to allow the government to buy is commitment that they will indeed have to repay, but it's very costly to default. This could be set up in a more general setup. If you recall, this is how much debt you have to issue that is going to be bought by foreigners, and this is directly what influences the value of default. And this is going to be some function of the total bailout. So this side that we have here in the original setup,
you have about 2 minutes, okay?
Okay. So I just wanted to say that these two cases are particular cases. If you finance the bailout issuing debt to foreigners, it's as if you set the sky equal to the inverse of the price. But if you finance it with transferring bonds to local economy, the sky is equal to 0. So these are two extreme situations. In one, there is doom loop, in the other way is not. But there are many points in between where you could also break the loop, doom loop. For example, with a low QX, with a low cost of financing the bailout, for example, financing by the ECB or by the European Union that does it at a lower cost. And this could also break the doom loop. Okay, but I will we have many extensions on this on the model, but basically this is the message of the paper. If when you introduce that banks' bond holdings affect default incentives, then limiting bank exposure might be undesirable, especially during the panic events. And we don't have necessarily that bailout commitments are desirable. They might be undesirable. There's no bailout commitments. So let me stop there. And be on time.
Thank you. Any quick questions before Matthias goes? Okay, Matthias.
Thank you. Let me stop sharing my screen.
Can you see the slides? Great. Then let me put them to full screen. All right. Okay. Thanks for being in the session. This is joint work with Francesco Giovanardi, Lucas Radke, and Florian Witnick, who are also at the University of Cologne. The title of the project is the preferential treatment of green bonds. So something slightly different from the previous presentation. So let me start by quoting the ECB, actually, which recently concluded their strategy reviews. So that has been headline policy news in Europe, where the ECB announced that they could introduce climate-related disclosure requirements for private sector assets as an additional eligibility criterion or as a basis for differentiated treatment of collateral or asset purchases. So that is a convoluted way of saying there is the prospect, or the ECB actively considers to treat green or supposedly green assets preferentially when conducting monetary policy. And as I already said, that was headline policy news in Europe this summer. However, the People's Bank of China, so the Chinese central bank, actually did that in 2018. And there is a nice small empirical paper that finds that this policy induced a large significant effect on green bond yields, in the sense that those yields went down quite a lot, like by I think 60 basis points after the introduction of this policy. And well, while there has been some research in the finance domain on how such a preferential policy could work, there is so far no macro model ready to evaluate the effects of such a policy on green bond issuance, green investment, pollution, and the adverse side effects of such a policy. And that is what we are going to provide in this paper. So we practically take a standard RBC model and augment it by a couple of frictions which are necessary to evaluate the preferential treatment of green bonds, which, well, first, an environmental friction, which is necessary to speak about or to have a notion of what is green or not. Then we're going to have firms that issue risky assets, so bonds, and banks which take these bonds and use them as collateral in addition to simply, well, invest into them. So bonds have kind of a dual use as investment object and as collateral. And the basic idea is that banks will increase demand for bonds that can be used as collateral, and specifically if the central bank is preferring green bonds, it will relatively, so banks will increase demand for green bonds relatively strongly. And the second part of the mechanism is coming from the firm side, which are increasing their bond issuance, their capital holdings, and also their leverage, crucially, in response to such an increase in the demand for green bonds. And within that framework that we that is relatively conventional, I would say we can come up with a collateral policy trade-off, which in that model here is determined by the central bank is willing to increase collateral supply to banks by lowering the collateral treatment, so by making more bonds eligible with it, which is a good thing. It tries to mitigate the associated negative effects of default risk, which are coming due to those firm responses, which is a negative effect. So that determines the optimal collateral policy trade-off in also more general setting. And if we add environmental friction, the central bank somehow, when it's benevolent, tries to subsidize green investment. So there's actually 3 dimensions that shape the conduct of optimal collateral policy in our model. And we find that in such a model, or with that additional instrument, preferential treatment can be quite powerful. Of course, it's a lot less effective than taxes, but I think that is not really a surprising result. What is an important result is that such a policy can have sizable adverse side effects on the real side. So in particular, since preferential treatment of bonds is an implicit subsidy of leverage, this policy has adverse side effects on financial stability, in the sense that green firms will default more often. And this leads to a characterization of optimal collateral policy where the degree of preferential treatment is actually smaller than what it could be. So you could go to an extreme situation and say, I'm only accepting green bonds as collateral. However, it turns out that this is not optimal, no matter how important that's exactly true, but even for very large values of this environmental friction. So even if environmental policy has a large weight in the social welfare function, optimal collateral policy never exhausts its maximum capabilities in all calibrations that we conducted. And we find instead that it's more like an imperfect substitute for Pigouvian taxation. So if the fiscal authority would be able to implement the optimal carbon tax, there would be no preferential treatment whatsoever. However, what is more interesting from a current policy perspective, whenever there is a suboptimal Pigouvian tax in place, there would be a welfare enhancement by conducting a preferential treatment policy. Okay, yeah, very briefly, the literature, it's still pretty young field, I would say. So there are a couple of environmental macro models pioneered by Heutel and Golosov, which kind of adds the Nordhaus integrated assessment models to a neoclassical growth model that has been augmented by nominal rigidities and also used to study how central bank can actually contribute to an active greening or to initiate a green transition. And there are some papers on green QE, on green refinancing operations, on green macroprudential regulation. And we kind of add the potential preferential collateral treatment to this list of policy proposals or analysis of policy proposals. Okay, so let me directly go to the model. There's going to be a very standard household sector, which is saving through deposit and supplying labor in a very conventional fashion. I'm not going to discuss that in much detail. Also, there is a competitive final good firms, which is supplying a final good to households and hiring labor. It gets more interesting when we come to the intermediate goods or intermediate production side of the economy. So this final good firm is actually buying intermediate goods from 2 types of entrepreneurs, which we label conventional and green. It hires labor and combines these intermediate inputs together with labor to this final good. And we assume that this final goods production function is subject to something that we label pollution, which is this calligraphic P here, which will depend on how much the conventional entrepreneur is producing. So you can think of that as energy sectors, for example. If you have a conventional energy sector which is very active, pollution is going to be high, which is going to reduce aggregate TFP, which is practically what the models of Heutel and Golosov and co-authors are using as a shortcut to model environmental externalities inflicted by conventional production. Well, and then this is subject to a shock, which is like completely conventional. Okay. The second important group of agents in the model are banks. There's going to be a representative bank, which is supplying deposits to households and buying corporate bonds, which we denote by BC and BG, so issued by the conventional and green entrepreneurs at prices QC and QG respectively. And following the money search literature, if you will, we assume that banks are active in two sub-periods. So they are going to buy bonds based on their deposit issuances in the morning period or in the first sub-period, and are going to be subject to an uninsurable liquidity shock in the second sub-period, which they have to settle against eligible collateral. Collateral is given by the market value of bonds on banks' portfolios, so Q times B for both entrepreneur types, weighted by a collateral policy parameter, which is the key policy parameter of interest in our model. And you can think of that either as a simple haircut. So increasing phi would mean bonds are subject to a lower haircut when they are pledged with the central bank as collateral. And you could also think of that capturing in reduced form heterogeneity in firms such that the eligibility threshold is going to be lower. So you might think of, you can also bring junk green bonds to the central bank in exchange for funding, and not only, say, investment graded bonds. And to induce banks to actually demand collateral, we assume, following Bianchi and Biggio in a recent paper, that banks are subject to liquidity management costs, which are increasing in the riskiness of bank assets and decreasing in available collateral. This leads to a relatively standard bond pricing condition, which is simply saying that the cost of purchasing a bond has to equal the expected payoff of buying that bond, which is discounted by the rate banks have to pay on their deposits, plus a wedge, which is the non-standard part here in this bond pricing condition. And this wedge is going to be determined by the marginal liquidity benefit a corporate bond has, which in turn depends on how much does the central bank actually, how does it treat the bond as collateral. So if that value here is very high, so in the extreme case, if every green bond would be accepted and there would be no haircut, that would introduce a relatively large wedge into the bond pricing condition. And on a more general level, this premium, this wedge increases in the collateral parameter phi tau. Tau is again type specific for green and conventional. The final bit of the model is going to be the entrepreneurs, so the agents issuing those bonds. We make them risk neutral but impatient, so they have an incentive to issue debt. And they will use linear technology for simplicity, which is subject to an uninsurable idiosyncratic shock following the canonical Bernanke-Göttler-Gilchrist financial accelerator framework. And we assume that they will default on their bonds if the production revenues do not cover the repayment obligation. So whenever the productivity is sufficiently low, the firm is going to default, and this specific default productivity level, or this threshold level, directly depends on firm leverage. And well, plugging this into the budget constraint, entrepreneurs are going to maximize shareholder value, so maximize the present value of their dividends, where the period budget constraint is given by dividends or entrepreneurial consumption, if you will, C tilde, plus investment has to equal the amounts of bonds issued times their market value, so the funds raised on the bond market, plus the sale or the real sale value of their capital, conditional on not defaulting, minus the repayment of outstanding debt obligations under the conditional on not defaulting again. So well, we before going to the numerical exercise, we're going to briefly show how that looks like in a simplified setting by assuming a very almost stupid functional form for the productivity shock by making it uniform, which enables us to get closed form solutions. And we can see that default risk or bond issuance is determined by a condition between relative impatience and marginal default costs. And key here, and that is also key to the pass-through of this preferential central bank policy, is that this collateral parameter actually goes via the bank bond demand into the investment and borrowing decision of the firm like that. So the collateral parameter incentivizes risk-taking by distorting this trade-off between relative impatience and marginal default costs. So it makes the entrepreneur issuing more bonds and investing into more capital. However, that is the interesting thing here qualitatively, is that this increases in bonds outstanding and capital investment go hand in hand with an increase in leverage. So in other words, the increase in capital is bounded by the increase in bonds outstanding. So a 1 percentage point increase of bonds, for example, would only pass through to 0.5 percentage point in capital in investment. So there is no full transmission of such a policy, which is qualitatively different from what a direct subsidy, for example, on green output goods, for example, would do. Okay. And since that qualitative result is nice, but we want to go a step further and compute like the quantitative effects of such a policy. So we practically take a lot of standard parameters from the RBC literature and then add a couple of bells and whistles to make the model more realistic, if you will. So we're going to use long-term bonds following Gomez and Cothers in 2016. We calibrate the productivity and discount factor parameters from the entrepreneurs to match some financial data, so leverage and spread levels. We're going to set the collateral framework in a way that it's generating a share of eligible bonds consistent with data. It's calibrated to the Eurozone. I should have said that. We're going to have liquidity management costs on the bank side parameterized in a way that the eligibility premium or the collateral premium is consistent with the data. And for the environmental side, we're going to target the damage to GDP ratio, of which there are relatively recent estimates available. And we're going to set the size of the green sector to 20%, which is consistent with the EU renewable energy share from 2 years ago. Okay, and within that baseline calibration, we conduct 3 different experiments. The first one, which is something I was already mentioning earlier on, is that we explore how much could the central bank maximally do by increasing phi-g to 1. So accepting every green bond that there is without a haircut and not accepting any conventional bond. That is actually a policy some people, some commentators actually proposed at some point, which would increase in our model the green bond share by 1.46 percentage points based from these 20% in the baseline, but only pass through to green capital by roughly half of that. So the pass through is really limited also on a quantitative scale. However, it is also increasing collateral supply above its optimum level. There's going to be too much default risk, but only a small liquidity benefit of doing so. So therefore, we are going to compute the optimal collateral framework, which is obtained by varying phi-c and phi-g independently. And we find that with respect to this utilitarian welfare criterion, the central bank actually does less preferential treatment than it could potentially do. And we find that this is then a relatively modest effect on green bond and capital share. So relative to the maximum, it's only it's less than half of that, which is actually really small if you compare that to optimal Pigouvian taxation, which is something we refer to as globally optimal policies. So we vary independently the entire collateral framework, phi-c and phi-g, and we add the Pigou tax and find that this taxation is an order of magnitude more powerful. Qualitatively, it does not distort the risk choice because it's not specifically targeted at subsidizing leverage, but it's simply making the production technology of green firms more profitable by paying green firms a subsidy on their output. And collateral policy is slightly adjusting second round effects of this taxation here, but they are of minor importance. So to give you some more numbers, here again, the maximum preferential treatment is associated with the welfare change, a modest one, with changes in the conventional leverage. And again, here you see how the green bond and capital share respond to this policy. And the costs of pollution decline modestly relative to the steady state value without policy, without any preferential policy. The optimal collateral framework achieves a slightly better outcome, obviously, on when it comes to welfare. However, again, it is putting much less emphasis on addressing pollution and is much more concerned with mitigating the adverse effects on leverage and collateral supply. So the leverage choice is much less distorted than in the maximum preferential case. And now, if you see the welfare effect here, you see that's a factor of almost of 25 between adding a carbon tax, an optimal carbon tax, versus let the central bank somehow try to address environmental frictions. So this again is kind of a negative result when it comes to should the central bank do something. So it can be welfare improvement, but improving, but really not so much compared to what the fiscal authority could do. Okay, we conduct 2 robustness checks regarding nominal rigidities and changing the elasticity of substitution between green and conventional goods. So even if you make them relatively easily substitutable, you still find that the tax is doing an order of magnitude better. What we can also do with the model is to compute the optimal collateral framework when there is a suboptimal tax. So, well, the most suboptimal tax is 0 in that case. So which is we are back to the optimal collateral policy framework, which I showed here in the middle column, which is modestly welfare increasing, and the welfare gain of tilting this framework towards green bonds is getting smaller and smaller the closer the tax is going to its optimum. So and in the optimum, you are not going to use any preferential treatment. So the collateral portfolio again reflects simply the market neutral share of green bonds relative to conventional bonds of 20% here. Okay, I have like 10 minutes. So 5 of them I think I'm going to devote to a plausibility check, if you will, of the model to show that the numbers we are getting out of this numerical exercise are not coming out of thin air, but are actually backed by some empirical evidence. So to do so, we are going. We collected ECB announcement of the prospect of preferential treatment. So anything that happened before 2021, so before this summer, where actually ECB board members occasionally hinted or announced that there's going to be a potential preferential treatment of green assets in the future. And we gather green bond data and compare them to conventional peers and look at the yield reaction around these announcement dates. We do a relatively standard propensity score matching on that and get around 100 matched bond pairs around each announcement date. And here you can see how much the spread between the green and the conventional bonds, so something which is referred to as greenium occasionally, how that reacts around these policy announcements. So it's relatively close to 0 prior to those announcements. And afterwards, the green bond yields on those European green bonds declines by quite a lot, actually, over one trading month. And we first view this as sign that the market takes these announcements as serious. So and second, that kind of corroborates the finding of the results on the Chinese bond market, where the finding on the green bond yields was similar, although it was a bit larger than in our case, but it's on a very similar order of magnitude. And we compare this empirically observed yield reaction to our model by interpreting this announcement as a news shock, a la Barsky and Sims or Boudry and Potier, and assume that this preferential treatment parameter is actually stochastic, and we assume that there is going to be a shock in so and so many periods. We conduct we consider different announcement horizons of 1, 3, 5, and 7 years, and we set the shock standard deviation such that it implies the preferential policy that we have discussed also numerically. And the model finds comparable or predicts comparable yield reactions of such a news shock here. So the data moment averaging over all announcements. So this was the cumulative effect, by the way. So the average effect was roughly 10 basis points, and with an announcement horizon of like roughly 3 years, we are pretty close to what the data are actually telling us. And given that most of these speeches were in 2018 and 19, and the actual preferential treatment is going to start sometime next year, this is actually pretty close to what the data are telling us. Okay. So I'm going to conclude and leave the last minutes for questions and discussion. So we provide a macro framework to discuss the effectiveness of preferential collateral treatment of green bonds, where the key qualitative ingredients are that preferential treatment induces risk-taking by green non-financial firms through this indirect subsidy of their leverage, and which leads to an imperfect pass-through, and that is quantitatively relevant. So only half of the additional green bond issuance will pass through green investment. And we then characterize and quantify numerically the maximum preferential treatment, which is quite powerful, but not what the central bank would like to implement. So in the optimum, a significantly smaller degree of preferential treatment is going to be implemented. At the same time, we also find that there would be no scope for preferential treatment if there's optimal taxation in place. However, once you cannot implement the optimal tax, which is probably the scenario we are currently living in with way too low carbon prices, preferential treatment would be an imperfect substitute for taxation. Okay. Well, thanks for your time, and happy to discuss. Otherwise, I'll pass the on to Bent.
Well, since you finished a little early, I mean, I'm curious about. I mean, the devil would be in the detail, right? I mean, how do you get your bonds defined as green? I mean, how can people play games with this?
Yeah.
And
that is an extremely fair question. So in the data, we are looking at bonds which are labeled as green by the stock exchanges themselves. So there is kind of a sub-segment of the bond market which is attaching labels to bonds as green or not green. There are obviously problems with regarding how reliable is this labeling. We cannot answer that practically. So we are kind of believing the labeling of bonds or the taxonomy of bonds into green and non-green, and proceed from there on. And I think that is all I can say about how we do it in the data. And in the model, I mean, we have this one parameter determining the size of both sectors. So there it's implicitly assuming that green firms only issue green bonds and non-green firms only issue non-green bonds, which again is a first pass, right? It's the most optimistic way of estimating the impact of such a policy, because in reality, probably also, I mean, firms are mixed finance in some way. So you could also think of firms that are simply substituting away their conventional bond issuance by a green bond, which would probably make everything a bit more murky and also in the model. And in that sense, we are probably providing an upper bound on what that policy can do. I think that is what I can say.
fair enough. Yeah. Any other questions?
Yes, can I say something? Matthias, very nice paper. I wanted to know something is, in this case, you have the same financial frictions for the two type of firms, right?
Yeah.
But if you saw that the green economy might rely more on intangible capital, then there's a strand of the literature that has emphasized that if you rely more on intangible capital, you might face tighter financial constraints. So I wonder if you were to include this possibility, if the third result that you have that the Pigouvian taxation is enough, could break in that case, because then you'll have the externality and the differential financial frictions. So you might need another instrument to go back to the optimal allocation.
Yeah,
On
I
top
mean,
of
I
the
cannot
taxation.
answer to that because it's completely right. Our model assumes symmetric financial frictions. If we talk about energy sectors where you could probably argue that also renewables are kind of capital intensive, I think what we're doing is fair. I agree if you have sectors which are by nature very capital intensive and have different types of financial constraints, then we would need to enrich the model, but we haven't done so far. But it's well taken, but I cannot defend the model in that sense, because it's like, again, the first step probably.
No, indeed, I was thinking more like a follow-up or an extension.
Yeah.
I will take your model and say, what happens if this intangible capital implies more harsher financial frictions?
Yeah.
If then I can give life to this possible policy of
No, then you would probably need more differentiated instruments also regarding the financial side. That's true. Although I doubt that this central bank frameworks due to the back door are the best ones. But I mean, yeah, agreed that yeah. All right. I should stop my screen sharing and give the floor to you, Ben.
Thank you. Yeah. Okay, so I will present the last paper, which is again quite different from the previous ones, but that's fine. Okay, so you see my screen? Okay, perfect. Thank you. So the current title of the paper is Expenditure Smoothing under Balanced Budget Rules, Rainy Day Funds, or Saving for Rainy Day. So in case you don't know what I'm talking about, so balanced budget rules is becoming increasingly more popular, where people try to put rules on the deficits that governments can run. We're going to look at US states, but in Europe, there's a lot of these kind of rules being generated recently, but also other places. So basically, balanced budget rules, think of that, means you can't run deficits. There are all sorts of small details, but basically it means that you can issue that. So rainy day funds is dedicated funds that governments put aside for budget smoothing. So you can't run deficits, but you have these piles of savings that you can use. And the title is hinting at people actually save much more outside of these rainy day funds. So that's what we're going to show. And this is joined with my colleague, Stephen Craig, and some of our current and former students. So US state governments spend an a large fraction of GDP, 10%. So fluctuations in revenue may have large welfare effects if that's reflected in expenditures. So some of the papers you read in the literature that talk about spending under balanced budget rules are basically assuming that expenditures are equal to revenues. So I'll show you that that's actually not quite the case here. Of course, if these shocks to the states are correlated, which they are when you're hit by an aggregate shocks, there's also stimulating effects in the economy, etc., that can be important. And anyway, if states actually can smooth these shocks, these effects can be minimized. So almost all states, apart from Vermont, have these balanced budget rules. And as I said, they might hamper the state's ability to smooth. And more states have these things that are always referred to as rainy day funds. And people have been writing quite a bit about these rainy day funds, about the rules, and about whether they're too small. And indeed, they are very small relative to the size of typical fluctuations. So the question in this paper here is how and how much do states, by which I mean state governments, smooth expenditures over time? So the first thing I want to get out of the way is basically, well, it's not that they are smoothing by adjusting the tax rate. So the tax rate, quote unquote, is calculated here as a state's own revenue divided by personal income. The grayscaled areas are the recessions, and it's not that the state systematically increase the amount of taxes relative to income in the economy. So basically, we're going to model revenue as exogenous as tax income. So the main finding in this paper here is that government smooth expenditures using other funds, which is not very instructive term. So that's what it's called in the Census Bureau data for the government. So what's going on? So other funds are a big kind of piling together funds. Many of these are funds that are actually allocated to state agencies. Like I'll use UH, the University of Houston, where I work, as an example. And nobody in the literature who talks about these issues have considered these, because these are sort of funds that are already allocated. But these funds actually, even though they might be held by various agencies, do a large part of the smoothing from savings for the state governments. So it's a very kind of a tossed together bunch of funds in the details. So it's hard to say sort of in very detail and precisely what goes on. But basically what I think goes on is that, think of the University of Houston, they hold assets. Every year they reach some amount X from the state government and spend the same amount, right? So roughly. So in a recession, the state government cuts us our money. So we'll say they receive half of X. If you work at a US state university, this is what happens. But they might actually, because they have funds, keep spending X, and they run down their assets. So in effect, the state can turn restricted funds into unrestricted spending just by limiting contributions. So these funds are not unrestricted for the state government, but they can still be used as a buffer in this simple way here that I point out. So just a figure would show the whole thing. So the revenue is the orange line. So and this is in dollars per capita, right? So like in the 2008 recession, we see here like a drop of like $700-800 in revenue for each single person. We call these other funds, we call them cash for simplicity. And you see these cash funds, like from the depth of the recession here in 1980, revenue went up by like $700. But these cash holdings went up by like $300. It's a huge amount of this increase in revenue that's being absorbed by these savings that hasn't really gotten any attention. And then when revenue dips in the recessions, the states run down these other funds. So these cash holdings that are in principle restricted do an enormous amount of the smoothing of the revenue shocks that occurs. This green thing here is the thing that has gotten all the attention, are the rules about how states can spend money from the rainy day funds. Too tight, or should the government be allowed to draw more of these rainy day funds? There are various, slightly varying between the states' restrictions on these, right? But if you look at this figure here, right, you can hardly see the movements in the rainy day funds because they're put in the same dollar scale. So what we say in the paper, these rainy day funds are basically theater. It's not something that really matters because they're too small. We can show similarly here how these cash funds, put them next to expenditures, right? You know, that from the press, etc., right, there's a lot of unhappiness when the expenditures drop in a recession by here it would be like $300 per capita. But the savings in these funds that no one has paid attention to is much more than $300, which means that if these funds were not there as buffers, expenditures would have had to fall twice as much. So we're going to try and see is in any way these use of these funds optimal. I guess that's why I'm in this session here, right? So I'm not going to write a very big, complicated general equilibrium model because you're going to have, it's going to be very hard to put realistic assumptions on the whole state government, we think. So we ask a simple question: if we fit a standard forward-looking rational expectation model, treating each state government as an agent, would that model fit the data? And what would be with the level of impatience? It gives us an estimate of impatience. Give us an estimate of risk aversion, would not be at a reasonable level, similar to the representative consumer. So that's what we're asking, because oftentimes it seems implicit in some of the public finance literature that the governments are just spending whatever comes in their hands. So there is a somewhat older literature that trying to say, well, do governments behave like PIH consumers? That's also in the international literature. Do they borrow abroad like PIH consumers, which doesn't fit the data very well. There's the extension of the PIH model by Campbell and Mankiw, where they say, well, but let's allow for a fraction of consumers that just spend all their income. So people try and estimate that and find various estimates, but they don't fit too well either. But some people think that, well, that would be the natural alternative, that governments just spend what they have. So in any event, we're showing here that, well, actually, government spending actually quite well described by the buffer stock model of care, which is a rational expectations, forward-looking model. So what we're going to match to, the model has agents with exogenous income risk, which we take to be revenue fluctuations. We use personal income fluctuations as an instrument to get it roughly exogenous. Agents can borrow, but that's exactly what the model type you should use of state governments that are facing balanced budget rules. And agents can save in a liquid asset, which is actually more realistic for governments than for individuals who have housing, they have stocks, they have all sorts of, whereas governments here are often pretty plain vanilla cash, even though they do hold all sorts of assets. Anyway, so we're going to estimate government's risk aversion discount factor by indirect inference. So part of what I'm going to tell you about is how we do that. So I'm going to outline for the rest of the paper. I'm going to talk a bit about the data, about the model, about indirect inference if I have time, and give a conclusion. So just for most people probably don't have a good feeling for the size of state budget. So the general revenue is about, on average, real terms, $7,000 per capita. $1,000 that is Medicaid, which is a program that's run half by the federal government and half by the states. This is a state's expenditure. So this is health insurance for the poor. not for the old. They receive something called Medicare. So, but these are big numbers. But what we are doing in this paper, we're actually looking at general expenditures minus capital minus Medicaid as a consumption equivalent. If you include Medicaid expenditure, you're not going to get something that's radically different, but there are also other programs. I mean, it's all, what is the best approximation? There are also other programs where the governments don't have full flexibility, but Medicaid is a really big part of this budget. So we take that out in the results I'm going to show you. And down here at the bottom, I showed you this figure in changes, right? But these cash funds that are spread all over government budgets, oops, that was not purpose, are in the order of $1,200 per capita, and the rainy day funds are $60. So they're totally dwarfed by these other cash funds. And people have thought of these as they're not unrestricted funds. So how can they be relevant for expenditure smoothing? And we thought so too, but then we did this figure. I mean, people haven't looked at the cash flow identity, so to speak, because it turns out, right, that the fluctuation expenditures are to a large extent not fully reflected in revenue, so not fully reflecting expenditures, and this here is a buffer. So we give standard deviations here. For example, fluctuations in general revenue, the standard deviation 1740. This average time series standard deviation, which is big relative to the size. The STD1 is the average cross-sectional. That tells you that there are big differences between states. But the thing we are interested in these fluctuations. So this is sort of the relative magnitudes of the data. In the model, we treat states as infinitely lived consumers, which is not a bad assumption for states. Presumably derive utility from non-durable consumption. Agents can save in a liquid asset, cannot borrow. Income exogenous. We allow for a permanent and a transitory component, which is treated quite differently. Usually in these models, they're very literally a random walk components and then a white noise component. And then in the next slide, we'll show how we map the government data into these concepts here. That the model, Carol developed this model as a model of individuals. So, the model, if you're not familiar with it, just a standard infinite one good von Neumann-Morgenstern utility function with a risk aversion parameter rho. There's a budget constraint, there's only one asset, and the money available at the beginning of each period, M, is called cash on hand. So that was a term that Chris Carroll labeled. So this cash on hand is an important statistic for us. So that's the wealth, that's the savings you have when you wake up at the beginning of the period, plus the income which is received at the beginning of the period. So M is available for consumption at period T. So this is just, there's nothing, I'm not saying anything here that Carol didn't say wrong though. Same on this slide here. So, so this notation here, P for permanent shock, nu for transitory shock, G is just a constant in the life cycle model, is of course the sort of predictable trend in income. And then there's a very small probability that you get zero income. So this for the state governments would be interpreted as a big recession. And so when if you cannot borrow and your income can go to zero, right, then for sure you would never ever let your assets go to zero because you have minus infinite utility of zero consumption. So One property of this model that Carol found, and again, this is Carol's world I'm reminding you of here, or telling you about if you don't know it, that the cash on hand behave as if there was a target. I just want to make sure to stress, it's not like the government has the politician have some implicit target in mind. It's just, I think I forgot to say one thing very important here. Agents are impatient. This is a crucial feature of the model. So roughly, this means that the discount factor is larger than the real interest rate. So ideally, agents would like to run down their asset holdings. So they would like to consume today and not tomorrow. But if C becomes 0, that term here will become minus infinity. That would totally dominate everything. So they cannot let the consumption go to 0, but they really like to not run up savings either. So this is sort of this tug of war in some sense between impatience and fear of running out of cash. And that's what Carol discovered. That gives this feature that savings will oscillate around a level which we call the target level. But don't misunderstand target to be as if this was a primitive assumption in the utility function. It's a feature that comes out of this combination of credit constraint and impatient. In the data, everything actually moves one-to-one with permanent income. So everything is in our equation to be scared by permanent income. So we can just, this here is also from Carol. So this shows if consumption around this target level, people would use a cash on hand that spend more than one-to-one if the target level is above the average. So that move down here. If you have very bad shock and your cash on hand gets down here, you'd really cut down steeply on your consumption in order to try and recover your buffer stock. Because here, your utility would go to minus infinity. Anyway, so Cepelli, Patula, Pistafari has a 2008 paper in the Journal of the European Economic Association, where they had some unusual data from Italy. They have a lot of data sets there, but they actually asked people, what is your target saving level? And then they tried to say, well, let's try and fit a model and see if these target savings level actually fit the buffer stock model, which has a theoretical target savings level. It actually turns out that it didn't work out for them. And probably because if you ask individuals, well, do they know what target level they have? But of course, it's contaminated with life cycle savings because people are not infinitely living. So they suggested doing this statistic here, which is it basically has the form of an IV estimation of consumption on cash on hand, using the deviation from cash on hand as an instrument. So they have some theoretical consideration about how this feature works, but how the statistics work. It's informative about how impatient you are, right? How big a fraction of your cash in hand do you typically use? We're not treating this as a structural equation with an exogenous IV. That's why I call it a statistic. We're going to estimate this data hat, and then we're going to use indirect inference to find the deep structural parameters, beta and rho. So in any event, what we do, we take 2 years as one period. Some states like Texas literally have 2-year budgets, and other states, in general, there's some slow adjustment. Anyway, we had Alaska, Hawaii, Arizona are quite different. Arizona actually, because they actually declined huge amount of aid from the federal government because they didn't want to give medical aid to the poor. So that's why they're not here. I always said the variables are normalized. Consumption, I guess I should speak faster. Government expenditure minus Medicaid minus capital. To make income exogenous, we regress expenditure on state level general revenue, on personal income. Use that fitted value. Permanent income is computed 3-period moving averages. We wasted quite a lot of time trying to use Kalman smoothing filters, but this has to be done by each state at a time, and they're just not long enough. Transitory income is the remainder dividing by the fitted values of permanent income. Cash on hand is cash funds, exogenous income. A target cash on hand, we estimate that as the average holdings for each state over time. So this covariance ratio and this target cash on hand, this here is in the data measured as how much cash relative to permanent income do the states usually hold. We're trying to match those with the model. So we're going to do indirect inference. So we have this vector. This is a general explanation. Various vector of parameters to be estimated. That's beta and rho. So we simulate a consumer model with these features, and then we get the simulated consumption. Then we regress. We get the simulated statistic that was called the covariance ratio. We get the simulated cash on hand. We do that a bunch of time. Check the average. This has the interpretation as an expected value. That's just typical simulated GMM methodology. We take the contrast to the actual data, and then we minimize that by iterating over the values of beta and rho. So I don't have time for these details. So let's skip that. So this is our estimate. So what we find is surprisingly, to me, low covariance ratio. It basically says that to the extent, I want to interpret this too much as a structure, but it's still informative. I still think we're trying to match that the government, on average, spend 22% of their cash at hand. So that's a pretty small margin of propensity to consume. I mean, this is not the level, this is the marginal. And the target cash on hand, so this here, that's just basically what you saw in the tables before. So this target cash on hand, the one is the income itself, right? Cash on hand was the income plus the savings. So it basically means that the size of these other funds is 18% of average income. So we estimate these, and then we do the indirect inference. We're still working a bit on it. We're not quite done. But what we get, I think there's something wrong with the standard area. That's very large. But what we get is we're not getting these voracious, that was a term used by Tornell and Lane for how governments behave in South America, voracious government. The discount factor, this is at a 2-year. There's actually a very, very low discount rate of a couple of percent per year, and a pretty typical for consumer models rate of risk aversion. So the fact that the model fits pretty well, we think, supports a point that these funds that formally are restricted are actually perfectly well considered as cash holdings, because the governments the money is saved by agencies, and the governments can adjust what they pay in whenever there's fluctuations in income. So to conclude, US state governments and their agencies, everything that's under the state government, hold assets of about 18% of revenue. Only 20 years of this is in rainy day funds. If you know this literature, this is what people write about and how these are too small and this and that. But we're saying this is just theater. This here doesn't matter at all. These much bigger funds that formally is restrained are doing quite a big job of smoothing revenue shocks. And whatever these rainy day funds do, it's pretty irrelevant because they're too small, which people have written papers about, but they did not look at the whole board ever and point out this other issue. So fiscal policy can be characterized pretty well as a model by optimizing forward-looking consumers. Savings patterns are as if they're chosen by a patient and risk-averse planner. And now, my last minute, I would just point out that we do definitely not think that there's some rational forward-looking governor sitting there. These preferences are some people in public finance call them as-if preferences. They are not clean preferences. They're a function of constraints, they're functions of everything. But clearly, some people are forward-looking. It looks like it's actually, and here I'm just talking loosely, right? But it looks like agencies like the University of Houston, the president knows every time there's a recession, our budgets are gonna be cut, and so they're forward-looking behavior somewhere in the system. And we're not writing a political economy paper at all, but we are saying that, look, there are these buffers in the system, and it's not happening through the form of rainy day funds. So, okay, I'm out of time and I'm out of paper, so I'll stop here.
I have a very naive question. I'm not familiar with your state's public finances, but I thought they are also indebted quite a lot, aren't they?
They are. Most of the debt they have is they have debt that are earmarked for capital projects. There's quite a lot of debt for building bridges and stuff. So in these other funds we look at, this is measured sort of from the asset side of government and measure all these assets they have. But we have pulled out all assets that are earmarked for pensions, because that's a huge amount of, but they do actually occasionally see in the paper use those to withhold pension contributions, but those we are taking out, and we are taking out some pretty huge amount of funds that they usually, when you issue something, you're building a bridge, part of